Welcome to This Explainer, where we're going to dive into the absolutely thrilling world of forensic audits for ACCA AAA. Think of this as your personal guide through a high-stakes financial true crime narrative. We're going to unpack the highly specialized strategies used to hunt down deception and explore exactly how professionals piece together the incredibly complex puzzle of corporate malfeasance. So, what happens when the numbers lie? And I mean, I'm not talking about an innocent spreadsheet error here or some misplaced decimal point by a tired clerk. No, I'm talking about deliberate, calculated manipulation designed to hide a crime. What happens when the very ledgers that are meant to protect a business are literally weaponized against it to conceal theft on a massive scale? Well, when trust is broken at the absolute highest levels, standard procedures just aren't going to cut it to uncover the truth. You need a completely different approach. Section 1. Unmasking corporate fraud. A surgical solution. Okay, so in a forensic audit, the auditor essentially becomes a financial detective, and they are hunting for a deliberate deception. If you're studying ACCA AA, you already know that this isn't your standard number crunching exercise. You aren't just ticking boxes to ensure compliance with reporting standards. You are actively tracking down a suspect. The killer in this scenario is the fraud itself. To catch them, you really have to get into their mindset by looking closely at the fraud triangle: motive, opportunity, and rationalization. Like, why did they need the money? How did the system even allow them to take it? And how on earth did they justify the theft to themselves? The mindset completely shifts from standard professional skepticism to active, incredibly focused suspicion. You basically have to assume the scene has been tampered with, that documents have been completely forged, and that the people you're interviewing are actively lying to your face. Section 2. Traditional versus forensic audits. The CSI of finance. Let's break down the exact purpose of a forensic investigation and contrast it side by side with the traditional financial statement audit. On the one hand, you've got the traditional audit. Its primary goal is ensuring financial statement compliance and providing reasonable assurance to shareholders that things are, generally fair and true. It's a broad systematic check. But on the other hand, we have the forensic investigation. Its exact purpose is to hunt for deliberate deception. A traditional auditor assumes management is generally honest until proven otherwise, and they usually rely on sampling techniques to test a portion of the transactions. A forensic investigator, though, they are called in precisely because someone already suspects management, or maybe a rogue employee is flat out lying. They don't just sample, they dig into the specific areas where the suspected fraud occurred, examining every single relevant transaction with an absolute fine-tooth comb. To put it simply, the traditional audit is a routine physical exam, but the forensic audit, that's an emergency autopsy. Section 3. Investigation planning, a methodical blueprint. So there are 3 absolutely essential steps for planning the investigation. Step 1. Identify suspicion of missing funds. You don't just start a forensic audit on a whim. There's always a trigger, and often this is a whistleblower. Now, why a whistleblower? Well, because massive frauds are usually perpetrated by the very people who have the power to override standard internal management controls. The usual checks and balances just won't catch them, so it often takes an insider stepping forward to expose the anomaly. Step 2. Define the exact scope. This is absolutely critical. If your scope is too broad, you're going to waste valuable time and money chasing shadows across an entire multinational corporation. But if it's too narrow, the fraudster slips right through your fingers. You have to draw a tight, impenetrable perimeter around the suspected crime scene. And finally, step 3, target specific financial crimes. You kind of need to know exactly what kind of monster you're hunting before you walk into the dark woods. Are you looking for embezzlement, bribery, or financial misrepresentation? If your plan is flawed from step 1, the criminal gets away. It really is that simple. Section 4. The 3 faces of fraud. Targeting the crimes. Let's rapidly unpack these 3 specific targets, which are, by the way, heavily emphasized in the ACCA syllabus. First up, corporate fraud. This is the big one. We're talking C-suite executives cooking the books and manipulating earnings reports. The motive here is usually to inflate stock prices, secure massive performance bonuses, or honestly, just hide impending bankruptcy from shareholders. What makes corporate fraud so exceptionally dangerous is that it almost always involves the overriding of internal controls. The very people tasked with designing and enforcing the security system are the exact ones bypassing it, making it incredibly difficult to detect from the outside. Second, asset misappropriation. Honestly, this is the most common face of fraud, and it happens at literally all levels of a company. It's the procurement manager creating fake shell vendors and authorizing payments to themselves, or maybe the warehouse supervisor quietly skimming high-value inventory out the back door over a period of, say, 5 years. It is stealing, pure and simple, usually driven by personal financial pressure.
And third, digital financial crimes. This is the rapidly rising modern threat. We're talking about sophisticated external hacks, ransomware, crypto siphoning, or maybe an insider using unauthorized system access to quietly wire funds to offshore accounts. The forensic auditor today has to be just as comfortable navigating server logs and digital footprints as they are reading bank statements. You got to be able to follow the money, even when it's just ones and zeros.
Section 5. Gathering admissible evidence. Building an airtight case. All right, once the trap has set and you know exactly what you're looking for, we enter the most meticulous phase of the entire process. The crucial point here is that it's not just about uncovering the truth in an office. You must use specific investigative techniques to gather legally admissible evidence. Notice the heavy emphasis on the words legally admissible. Meeting the strict legal standards required to hold up under the scrutiny of a judge and a highly hostile defense attorney is exactly what separates a true forensic auditor from an everyday accountant. I mean, if you find the smoking gun, but you break the chain of custody, that evidence gets thrown right out. For example, if you improperly copy a suspect's hard drive without using specialized write-blocking software, the defense is going to argue you altered the files. If you conduct a coercive interview without legal counsel present, poof, that confession vanishes. The fraudster walks free. Every single email recovered, every cloned server, and every financial discrepancy documented must be handled flawlessly, maintaining an unbroken, documented trail of exactly who touched what and when. You are building an airtight legal case, literally brick by financial brick.
Section 6. Quantifying the financial loss. Calculating the tally.
So the investigation has cracked the case. The method is known, and the culprit is completely cornered. But the most important question for the victims, the shareholders, and the courts still remains. Exactly how much was really stolen? Quantifying the exact financial loss is where the forensic auditor brings the entire narrative to a close. It is absolutely not enough to just confidently say, hey, they stole money. You have to calculate the precise, verifiable amount down to the penny. This final tally is essential for three major reasons. For insurance claims, to make the victimized company whole, for civil litigation to recover the stolen assets, and for determining the criminal sentencing guidelines of the fraudster. This is the exact number that the judge reads out right before dropping the gavel. Reaching this number requires painstakingly piecing together years of manipulated records to basically recreate the true financial reality that the fraudster tried to permanently erase. But, it goes beyond just adding up the missing funds. A key part of this stage is tracing. The forensic auditor must track exactly where those stolen funds went, where they funneled into real estate, offshore shell companies, or maybe luxury vehicles. By tracing the complex flow of the illicit funds, investigators can actually freeze those assets and begin the process of recovery, ensuring that crime literally does not pay. As we wrap up this explainer, I want to leave you with a pretty provocative thought to consider. Are your own corporate safety nets truly secure? Because understanding these ACCA, AAA concepts isn't just about mastering an exam syllabus. It's about realizing how incredibly vulnerable real-world organizations actually are. Fraud isn't just something that happens to other companies. It happens wherever internal controls are weak and where people are trusted just a little too much without proper verification. So take these forensic principles, look closely at your own financial environments, and ask yourself, if someone were hiding a crime in your numbers right now, would you have the tools and the skepticism required to unmask them?